Hello everyone. For today's subject of Applied Corporate Finance for Semester 1 2022 and 2023, we are going to present on Nike and American Greetings case study. Before I go further into the case studies analysis, let me introduce my teammates. My team members are Noor Ashraf, Kamal Alec, Lamis, myself Divya, Wong, Nuru Nadia, and Fiona. Our first case study for today is Nike. I go further into understanding what is Nike, let me tell you that Nike is actually a very famous brand for sports. So the question here is, do you agree with Joanna Cohen's WACC calculation? Our answer here is no. Before I further justify why our answer is no, let me explain to you the definition of WACC. WACC means weighted average cost of capital. WACC represents a firm's average after tax of cost capital from all sources. The sources could be common stocks, preferred stocks, bonds, and other forms of debt. WACC is the average that a company expects to pay to its finance for the assets. So the reason for saying no is because Joanna Cohen has used historical data for the cost of debt calculation. In this situation, market value consideration seems appropriate. On top of that, average beta from 1996 to 2001 is definitely not an optimally representing data for the future beta of Nike. So to further justify why did we not agree with Johanna will be further justified by my fellow teammate Ashraf.
Thank you, Divya, for the detailed explanations. On my part, the question is, if you do not agree with the Cohen analysis, calculate your own calculations for WACC for Nike and provide your assumptions with some justifications. So as we can see on the screen, so there is calculations about the WACC, and at the end, so we can see the debt is about 7.1.6%. Hence, after tax cost of debt, it will be 4.44%. For the next questions, my fellow colleague Nadia will take from here. Over to you, Nadia.
The cost of equity is the return that a business needs to determine if an investment satisfies capital return criteria. So, we use CAPM formula to calculate the cost of equity. The rate of return paid to equity investor by Nike was 9.81%. The advantage of using CAPM to calculate cost of equity: first, it's simple and easy to calculate and vital in WACC calculation. Secondly, it eliminates unsystematic risk, which consider only systematic risk, and it also illustrates the relationship between company asset risk and expected return. The disadvantage of cost equity calculation using CAPM was, first, it's difficult and time-consuming to determine beta. It unrealistic assumption of risk-free rate and focus only single period time horizon. Dividend discount model allows an investor to calculate a fair price for a stock based on estimated of the amount of cash it will return in current and future dividend. DDM is one method for calculating a stock intrinsic value. In this case, cost of equity as per dividend discount model is 6.7%. The advantage of using this model is, one, it's simple and very easy to understand. Second, it depends greatly on theory and ability to stay consistent over the lifetime of the company. The disadvantage of DDM are the difficulty in making accurate projection, the absence of buyback, and the fundamental assumption of income derived solely from dividend.
Right. Thank you, Nadia. So what are we recommending for Kimi4 to perform on the analysis? From my team perspective of view, we will recommend Kimi4 to perform DCF analysis. The reason of being is that in order to use DCF analysis, Kimi4 can compare the present value of the future cash flow to the initial investment and determine whether the investment is likely to provide an acceptable return. This allows Kimi4 to make a more informed investment decision to allocate their capital more effectively. Additionally, DCF analysis can help investors to identify the key drivers of an investment value and assess the sensitivity and estimates the changes in the key assumption, such as the growth rate and the discount rate. So in the end, The calculations for the calculations is that weight of equity is 89.9% for Nike, and the weight of debt is 10.1%, and the WACC is actually 9.27%. And now I will pass it to American Greetings. Thank you.
All right, so now let's move on to the American Greetings case study. Currently, American Greetings is trading at an EBITDA of 3.5 times, whilst comparable firms are at 7.5 times. The share price of American Greetings, as per this multiple of the average EBITDA of the industry, is almost $32.53 per share. This indicates that the company is undervalued, especially due to the prospects and plans of American Greetings' growth, which has been shifted into technology. Given this, the EBITDA multiple should be closer to 5 times. This is still lower than the average of 7.5 times, as for this number to be achieved, share prices would have to increase by 200%, which is highly unlikely, or the company could also issue $1 billion in debt or cut their EBITDA by 60%, none of which would be good for the firm. American Greetings currently has a net worth of $86 million. So should they spend this cash, it would directly increase the EBITDA multiple, but not by much. Spending this cash could possibly direct the multiple indirectly through market capitalization appreciation if spent wisely. Given that the share of American Greetings as per EBITDA multiples is much higher than the current share price, this suggests that the shares of American Greetings are trading at a substantially lower level. In this scenario, it is recommended that the management should pursue the share buyback option, with the firm spending $75 million in share repurchases in order to boost share prices, and therefore return the EBITDA multiple to a more justifiable level of 5 times.
So DCF valuation forces us to think about the underlying characteristic of the firm, fundamentals, and understand its business. To develop a model of American Greetings' future cash flow and also to incorporate those into our DCF model, we must first identify the company's core revenue and earnings and calculate its weighted average cost of capital and to be used as discount rate in the model. So we use the information that were given in the article. After inputting key drivers and assumptions, these are the figures that we got for the projection of the company's forward cash flows. As you can see, the net incomes or cash flows that the company is expected to produce are 75, 78, 80, 83 million for respective year 2012 to 2015. And the next slides, these are the key assumptions that we used in incorporating the DCF model for the company. So we decided to use such conservative assumptions, or shall we say bear case, due to the gloomy outlook of the greeting cards industry. So we believe that using such conservative measures would lower the risk. In terms of finding the terminal value, we use a perpetual growth rate formula of 3%, and also the EV/EBITDA multiple valuation of 7.6, which is the median of the industry. So we just find those terminal values, and we average them up. And then the next slide, these are basically the weighted average cost of capital. We calculate the weightage of the company's equity and debt, and we got 8.49%, and will be used in the model. Next slide, regarding the implied valuation after incorporating all. So these are the key output figures. So we got terminal value of 1.5 billion after the average of those EV/EBITDA multiple, and also the perpetual. So we then add this figure with all the projected cash flow and discounted with, of course, the 8.49%, and we got an enterprise value of 1.867 billion. And of course, this is the enterprise value. So to get the equity value or market capitalization, we deduct this figure with total debt and add their total cash and or equivalent in hand to get the value of 1.718 billion. All in all, we got the implied equity value share of $44.83. Of course, after dividing with the number of shares outstanding, we got this figure, and we think that is a bargain compared to the current price of the company.
Hi, For recommendation part, AG should repurchase the share if the company is optimistic about the future of the business. Analyst has said that the product innovation in the company is needed to drive the interest of the customer in the company's good. The valuation will improve if technological enhancement is left to be the key for companies' long-term approach. And instead of this is the rolling of several complementary interactive goods, such as mobile apps, as one of the innovative move with the aim of bolstering the company's digital position. From the information provided in the case study, the effect of technology is evident. An illustration of this is that with the introduction of social networking sites such as Facebook, some respondents have claimed that they are sending fewer e-cards that they used to send, since most of the greetings are being sent through the social networking sites. Thank you.